Hello, everyone. Welcome to another SynMax webinar. I'm Sophia LaChapelle, an account manager here, and I'm joined by Eric Anderson, our CTO, Tony Frangi, our head of energy fundamentals, and Mark Passy, our newest senior oil analyst, who's going to be helping us build out our oil offering, and he joined back in October. Sorry that this webinar is going to be asynchronous, but as always, we do offer the option for you to submit questions. So just email us at support@synmax.com, or you can email me directly at sophia@synmax.com. Today's our quarterly production webinar, so our team is going to go over any updates to our long-term forecast and review the accuracy of the model in the past quarter. We're going to cover both oil and gas updates, as well as any key highlights from the producer earnings calls. And with that, I'll go ahead and hand it off to Eric to get us started.
Awesome. Thank you for that introduction, Sophia. My name is Eric Anderson. Like Sophia said, I'm the Chief Technology Officer at SynMax. I want to thank everybody for taking time out of your busy Friday to watch a recording of the webinar. Very sorry about those technical issues we're having. We wish we could have done this live, but we are going to make it available that you can ask us your questions via email or even hop on the phone with us if you'd like to discuss anything that we review in this webinar. So this is our Q3 24 earnings review webinar. We're also going to be reviewing our natural gas and oil forecasts, as well as the performance of the long-term natural gas forecast over the period of September through November. A quick agenda. So first, we're going to do our long-term gas forecast performance review. It's a little bit different this quarter because, as you remember, we did update our long-term natural gas forecast in November. So we're going to be reviewing the accuracy of both those forecasts this time around. We're also going to be reviewing the accuracy of our rig and frac crew satellite measurements. Every quarter, a lot of the producers will tell us what they have ran as far as rigs and frac crews over the previous quarter. We can compare that against our own proprietary data and make sure that we are in alignment with the market. What we like to see is a 95% or above accuracy rating. We're also going to be updating our pipeline scrape regression model as we do every single quarter. We're constantly bringing new data in from the state and measuring to make sure that our pipeline scrape model is in line with the latest state data that we're seeing. And then once a quarter, we will make an adjustment to that model. So we'll be going over the changes in that model today. As well as we're going to be looking at an updated oil forecast. As I said before, the long-term natural gas forecast has not updated. We have rebased it to match our new expectations with the pipeline scrape regressions, but we're going to be updating the oil forecast. After that, I'm going to pass things off to Mark Passy and Tony Frangi, who are going to talk about what we're hearing from producer earnings and what our updated expectations are going forward for both oil and gas production. Of course, since this is a recorded webinar, we're not going to have a Q&A, but we welcome all your questions over email or if you'd like to set up a meeting with us. All right, so let's talk about the total lower 48 long-term forecast accuracy. The way we measure that is through mean absolute error. And because we updated our forecast in November, I'm going to be going over both of those. So the prior forecast had a mean absolute error of a BCF a day. As you can see, that's mostly coming from November. So there are three reasons why we decided to update this forecast early instead of waiting for the quarterly webinar, which is what we usually do. And that's because, one, we were seeing from producers that they were lowering their expectations for production. As you know, November weather has not come in favorable to increasing production, and so that really wasn't much of a surprise. But 2 and 3, we were seeing anemic frac crew data. We weren't seeing the kind of frac crews and completions getting committed to make that forecast make sense anymore. So we wanted to update it as soon as possible to give our clients the best possible estimation of what future production could be. And then finally, we revised our detail expectations. If you've been following us for any time, you know that we're the only company that's tracking details in real time in the Haynesville and in the Northeast. There's about 3 BCF a day of delayed but unturned in line wells collectively in those regions. Originally, we were expecting those details were going to come online starting in November. Due to the warm weather, it looks like producers have delayed when they want to bring those details online. Our expectation now is that they're going to bring them on ratably through 2025. So we revised that forecast down. The new forecast, if you measure it November all the way back, it's a 0.53 mean absolute error. So the major regions where that revision occurred was in the Northeast as well as in the Gulf, particularly Haynesville. That's where the details are, and that's where the marginal production tends to be, especially in the winter. So you can see the revision in the Northeast here. We revised it down. Our mean absolute error On our current forecast is 0.21 BCF a day. On the prior forecast, 0.56 BCF a day. Again, we're getting punished because of that November change in expectations. On the Gulf, this difference is mostly coming from the Haynesville, which we'll unpack in detail in just a moment. But the mean absolute error on the forecast we currently have pushed out is 0.32 BCF a day. And on the previous one would be 0.53 BCF a day. Getting into specific regions, West Texas is one region where we did not make any adjustments to our forecast. We maintain our view in West Texas. When I look at these accuracy charts, there's really two things I like to see. I like to see a low mean absolute error relative to the amount of production in the region, which I think we achieved in West Texas. That is the Texas side of the Permian. I also like to see that we're capturing the trend well, and I think we've done a good job with that. Of course, you can't have a slide on West Texas without talking about the Matterhorn pipeline. I think everybody has different expectations for how much new gas is flowing on the Matterhorn pipeline, right? So the Matterhorn is a 2 BCF a day pipeline. However, the big question is, of that 2 BCF a day, which is likely flowing, how much of it is from new production that needs to be captured in order for you to accurately know what's being produced on the Texas side of the Permian? Our belief is that it's between 1.3 and 1.5 BCF a day. There's not a lot of hard data to really go on to support these beliefs, but we have one advantage that other people don't, and we have our short-term forecast. Just a reminder, our short-term forecast is based on actual satellite observed completions and then modeled IP and decline rates on top of that. And, this 1.3 to 1.5 BCF a day of new gas assumption aligns really well with our short-term forecast. So that's what we've baked into our long-term forecast. It's also what we've baked into our pipeline regression model for the region, is that assumption. And stay tuned as that assumption changes and updates with new information coming in. We're going to keep our customers informed on that. Moving over to the New Mexico side of the Permian, we achieved a mean absolute error of 0.14 BCF a day, which we're very proud of. And then going into Haynesville, Louisiana, which is the final region where we did have an adjustment in our November forecast, we revised production down. So the current model has a mean absolute error of 0.22. The old forecast would have a mean absolute error of 0.32. Again, this story is really coming from two areas, the frac crews and the details. Haynesville is where we see about 0.8 BCF a day of delayed till capacity sitting and waiting for the right opportunity to come in. Our original expectation, as you can see on the chart here, was that was going to come in November. We now believe it's more likely to come in 2025. Of course, that view can always change. If we get a lot of cold coming in, if we get a lot of reasons why it would be advantageous for producers to suddenly bring their details online, well, first of all, you're going to know about it because we're tracking those details in real time. You're going to be getting alerts in your inboxes. You're going to be seeing research pieces on it, and you're also going to be able to access that data via our API. But our belief right now, based on mostly what Expand is saying, is that 2025 is when they're likely to bring those details on. All right, as we discussed before, we like to track our rig and frac crew accuracy against what producers are saying. Our goal is to always stay above 95%, which we achieved with both rigs and frac crews. We had a rig accuracy of 95% compared to what the producers were saying they were running in rigs, and a frac crew accuracy of an impressive 99%. We've been running this model for years now. We're very good at spotting these things. We're very good at capturing all of these frac crews and rigs. I firmly believe we have the most accurate rig and frac crew model available anywhere. And this is proved out by the fact that we align very closely to what the producers themselves are saying they're running in previous quarters. As I also discussed, we updated our pipeline regression model. So that process is really just looking at the latest state data that's coming in, comparing against the pipe scripts, making sure that those relationships are still tight. It's very uncommon for us to make a change if we're doing this regularly, we're doing this correctly, of more than a BCF a day, right? We like to keep it dialed into less a BCF a day. And this quarter, the average change over the 12-month period is going to be 0.34 BCF a day. So that's a revision upwards on the daily production model of 0.34. And that's just coming from, indications in the state data that those pipeline regressions are changing somewhat. The pipeline data, it's always a sample. The state data is the closest thing you're going to get to God's truth, right? So when we do that comparison, we make sure that we're dialed in and that our forward-looking assumptions are accurate as far as what daily production is. If we look at the regional breakout, on the high side, West Virginia, South Texas, Permian, New Mexico, we all revised up. It looks like those relationships are showing that the state data is running a little bit above what the old pipeline regressions are, so we're revising those up. And then on the downside, Haynesville, Louisiana, Gulf of Mexico, Pennsylvania, as well as just a little bit in West Texas, 0.09 BCF a day. I almost consider not even including it on this chart. It's such a small amount. But we do pride ourselves in staying on top of those pipeline regressions, making sure that the data you're getting and our pipe model is always very accurately tied to the latest relationships between state production and pipelines. All right, so like I talked about before, we did not update our natural gas long-term forecast. That update occurred in November, and we're carrying that view forward. However, there's something called a rebase. So it's important to us that we keep all of our forecasts in sync with each other, right? So we have our short-term forecast, our long-term forecast, and we also have our daily production model, which is a forecast because it's based on a sample grossing up to the total. All those three things always need to be in sync with each other. Usually we update them all at the same time. And so in the background, there's something called a rebase, which means we're adjusting the long-term forecast to fit the latest pipe scrape relationships. So this exact same data that you saw in the previous slide here, right, these regional adjustments on the pipe scrape model, well, those get applied to the long-term forecast. So the long-term forecast is not changing. However, it is rebasing, which means it's going up by about 0.3 BCF a day, right? The same numbers that we saw in the daily pipe scrape model. And then finally, we're updating our oil forecast. Our new senior oil analyst, Mark Passy, has got a lot more details on this, but I wanted to kind of just broadly show what the update was first. And so it's looking like we are revising that up. And in just a moment, Mark is going to dive into the details on exactly why that is. But first, I'm going to pass things off to Tony to talk about producer earnings.
Thank you, Eric. Looking at the main themes from the third quarter producer earnings reports. Once again, most producers outperformed on the midpoint production guidance estimate for the third quarter of 2024. And of course, the outperformance was in all products, crude oil, natural gas, and natural gas liquids. And even Northeast producers outperformed on natural gas production for the midpoint of their guidance, despite having shut-ins during the quarter. U.S. oil production has grown sequentially in the second half of 2024 as expected. 2025 is very likely to see some slowdown in year-on-year production growth in crude oil, but it's still going to grow in 2025 compared to 2024. Matterhorn Express Pipeline has made a difference not only in production, increasing production by 1.3 to 1.5 BCF a day in the Permian, but it's also made a significant difference in Waha pricing by increasing prices by around $2 per MMBtu in the spot market. Also, efficiency gains have accelerated in the third quarter 2024, and this is especially in the case in the Permian Basin. And finally, number 5, producers can cut CapEx significantly, and simultaneously they can increase production, and worst case scenario, keep it constant.
I got it.
Switching to the next slide. These efficiency gains are going to continue into the fourth quarter of 2024 and into 2025. Producers continue to achieve record high lateral lengths and record low cycle times. Matador Resources continues to have great success in the Permian with trimul-fracking. And once again, producers continue to reduce CapEx and simultaneously increase production or keep it constant. And the majority of the CapEx reductions have actually been from efficiency gains, not from cost deflation, although producers have had some benefit from cost deflation. And once again, efficiency gains are most relevant in the Permian, but still significant in the Northeast. Port Energy, for example, said that they are drilling over 30% more feet per day than just 1 year ago. And they said that simul-frac has resulted in a 40% increase in frac feet per day. And they are now looking to do U-shaped wells in order to get 3-mile and 4-mile laterals, which is going to be the norm for new wells going forward for them. EOG Resources said that they increased their maximum pumping capacity per frac crew by 15% year on year. So that's another pretty incredible feat there. EQT said that they are completing their completion footage per day is 35% faster than 2 years ago. 2024 production is tracking above the high end of our guidance when normalizing for curtailments. And now EQT is saying that they should be able to pull back 1 frac crew if they continue to have these efficiency gains without any effect whatsoever on their production. Number 5, Antero Resources says that the average days to drill a well has reduced from 11 days from 14 days 2 years ago. And the company can keep production flat while significantly reducing their activity in frac crews and rigs. Comstock Resources, their Western Haynesville position continues to outperform. They are now been doing U-turn or horseshoe wells, which is innovative design, which allows 2 9,200-foot laterals to replace 4 sectional laterals, saving about $530 per lateral foot. This is an example of some of the efficiency gain methods presented here by Matterhorn on their presentation slides for the third quarter. Simulfrac, trimulfrac. Trimulfrac saves $350,000 per well. That's compared to a traditional zipper frac well. U-turn wells saves about $3 million in savings per well, and their days on the well have been reduced by 16% from a year ago. So it's pretty incredible what they're doing. Switching topics now to the lower 48 pipelines, new generation gas gathering, or sometimes referred to as NG3. This project should be built and finalized in the fourth quarter of this year. It should add on another 0.2 BCF a day incrementally in the fourth quarter. They have added 1.5 BCF a day in the prior 3 quarters. So the total is about 1.7 BCF a day for this new project, which is going to bring gas from the Haynesville into the LNG markets ultimately. The next 2 projects are Permian pipelines. They are very large pipelines that are going to come on in 2026. The first one is Blackcomb Pipeline. It's a partnership with Whitewater and Enbridge to build a 365-mile natural gas pipeline from the Permian Basin in Texas to the Agua Dulce area in South Texas. The pipeline is expected to transport up to 2.5 BCF a day, and it's expected to come online in the second half of 2026. Devon Energy, Marathon Oil, Diamondback Energy, and Targa are expected to be the major shippers on the pipeline. And of course, this is an intrastate pipeline. The other pipeline in the Permian is Hugh Brinson Pipeline, formerly known as Warrior Pipeline. It was recently FID'd by Energy Transfer. It's an intrastate pipe that's going to be built in 2 phases. The first phase is going to be 1.5 BCF a day, bringing gas from Waha in West Texas to Maypearl, Texas, located just south of the Dallas-Fort Worth area. Phase 2 will increase capacity by 0.7 BCF a day, and both phases are expected to come on in the second half of 2026, and the total will be 2.2 BCF a day. So these are 2 very big pipelines in the Permian that will allow for additional significant natural gas production. Switching to the next slide. Switching topics again a little bit here. Private frac crews versus public frac crews from the producers. Private producer fracking activity continues to outpace public producer fracking activity for the lower 48. And big reason for that is because the public producers have been busy with M&A and reducing some CapEx as a result, and they've had some synergistic efficiency gains from that due to the M&A. And also, some of the public producers have been increasing their dividend payouts and their share buybacks at the expense of some activity.
Yeah, this is one of those things, Tony, looking forward to 2025 might change again with ExxonMobil's big announcement about their acceleration of efforts in Permian. So yeah, it's one of those things that bears watching.
Yeah, absolutely. Going into the forecast for the long-term production forecast for the lower 48, again, these changes were made on November 11th, so nothing has been changed since that time. 2025 is expected to be up 2.9 BCF a day year on year. That's down 0.4 BCF a day from the prior quarter. Again, additional producer guidance sampling from Expand Energy and the fact that they are looking to bring on the great majority of their details in 2025 in equal increments led to some of the decrease in our expectations for growth in 2025, but it's still going to be significant growth. Fracking and rig activity is not expected to increase until Q1 of 2025. That's a market reduction from when we were looking over the summer. People were expecting Q4 2024 activity to pick up a lot, but the very warm November and some of the lowered expectations in natural gas pricing caused producers to cut back some. The other reason for the increase is the lack of curtailments in 2025. If you look at the forward curve at Dominion South and Henry Hub, there's basically not going to be any curtailments in 2025. And that alone will lead to a BCF a day year-on-year increase in production in 2025 compared to 2024. The other issue is the potential for no freeze-offs in the first quarter of 2025. If there are no freeze-offs, that would lead to an additional 0.2 BCF a day year-on-year increase in 2025 production. So switching over to the oil from Mark.
Thanks, Tony. So as you can see, we expect production to be up year on year by roughly 300,000 barrels a day, but that's up almost 150,000 barrels a day from the prior quarter. Now, what most of that is on higher realizations from New Mexico, especially the Delaware, of course, productivity is just phenomenal, and reduced freeze-offs. Really, we reduced our assumptions on freeze-offs. We really were a little aggressive prior to now. And as you can see, that's really been most of the increase. We're not particularly more bullish on how much production people will be drilling, though. Hold on for Exxon, because Chevron has said that they're looking to scale back their growth. They still expect somewhere between 50 and 100,000 barrels a day growth, but didn't really specify a time frame. That could be over several years. Exxon's the big story. In their upstream in CapEx update a couple days ago, they didn't give an annual number, but if you read between the lines on the big top line numbers they gave, Permian's looking to grow somewhere around 200,000 barrels a day with Exxon. And as we've said before, you cannot understate the level of improvement in completion design and drilling success that producers have had with everyone expanding on these new techniques.
Switching over to West Texas natural gas production. Again, we didn't make any changes on November 11th in this subregion. And overall, we expect 2025 production to be up a BCF a day year on year. And that is unchanged from the prior reporting quarter. As we stated again, efficiency gains are strongest in the Permian, and the production outperformance continues unabated. Whatever activity increases we see, such as from Chevron, will be more than offset by what ExxonMobil does, in addition to efficiency gains and debottlenecking from the other producers and the debottlenecking from the Matterhorn pipeline. And trimul-fracking is a huge success in the Permian Basin, and it's going to continue to expand in the region, and it might even go into other areas such as the Northeast or Haynesville. Number two, Matador Resources continues to have success with trimul-fracking. Trimul-frac yields a 50% reduction in completion time. Number three, Oventive. This was interesting because they said that 60% of their new wells in 2024 were trimul-fracked, which is a market increase from their original plans of 50% of the new wells to be trimul-fracked. And Mark was pointing out earlier that Oventive now is looking to do 75% of their new wells in 2025 to be trimul-fracs. So this is a new trend. It's been very successful, and it's going to accelerate. Next slide.
So we've talked already about Permian really in the top level number. Most of the number here is up 189,000 barrels year on year. But as you can see, we didn't change it substantially from the last quarter, mostly again from the effects I've noted before. Specific producer news: EOG is expecting to grow at a slower pace, which was pretty rip-roaring in 2024, and they're going to run relatively flattish activity. But as we've said, that doesn't mean you're going to have flattish results. Civitas actually is saying if oil's in the low 60s, they wouldn't grow production, might even let it reduce a little bit. We'll talk a little bit why we don't think that low 60s is a realistic kind of number. But again, they think they should hold back based on the current fundamentals, which really feeds into this next one. Exxon has talked about their cost of supply being $35 in Permian, and now that's not exactly a break even. So it's tough to compare apples to apples here. But they do expect to double production in the Permian over the next 5 years to 2.3 million barrels a day, with most of that by 2027. And when asked about this effect of the fundamentals of increasing supply at a time when the market appears to be oversupplied, Exxon CEO basically said When you're one of the lowest cost producers, that's somebody else's problem. So
switching over to South Texas natural gas production forecast. Again, we expect South Texas natural gas production to be down slightly by 0.1 BCF a day in 2025. And again, we did not make any changes to this on November 11th, and it is unchanged from the prior reporting quarter. The subregion is likely to not see any activity increase for natural gas until EOG Resources decides to increase CapEx in the Dorado, which is probably not going to happen until 2026 through 2027 when we start to get the U.S. LNG export boom, which should materialize. Matterhorn pipeline should cause natural gas production in South Texas to temporarily drop until the middle of 2025.
Again, we didn't see a substantial change in what we're actually forecasting for South Texas other than reduction in freeze-offs. And that reduction in freeze-off assumption really sort of lifted, as you can see, our production for the entire year. So there's really no real news for oil in South Texas.
Switching over to the Northeast to natural gas, Pennsylvania, Ohio, and West Virginia. Again, while we revised it slightly down from the prior quarter on November 11th, we still expect production in the subregion to be up 0.7 BCF a day year on year. And overall producer efficiency gains are offsetting curtailments, and we're going to have details starting to come on from Expand Energy ratably into 2025. So they would bring it on in equal increments each month based on their current guidance. EQT, once again, production still outperformed the high end of their guidance range, even after adjusting for curtailments. They're looking to convert their frac fleet to electric, and they have completed their completion footage per day is up 35% compared to 2023, which is quite incredible. National Fuel, their Seneca production arm, said that their CapEx will be down 10%, while their production is going to be up simultaneously. They have drilled 20% fewer days than originally budgeted in Tioga County, and they expect their efficiency gains to continue into 2025. Switching over to the Haynesville, we're not going to see two different Haynesvilles, Haynesville, Louisiana, Haynesville, Texas, in 2025 like we did in 2024, where in 2024 we saw Haynesville, Louisiana drop quite markedly, and Haynesville, Texas went up a little bit due to the activity increases from Comstock in the western part of Haynesville. So in 2025, the two subregions should be fairly equal in their growth. We revised them down slightly from the prior quarter on November 11th, but we still expect growth of 0.3 BCF a day year on year in Haynesville, Louisiana for 2025. And we expect Haynesville, Texas in 2025 to be up 0.2 BCF a day. Comstock Resources, their successful first horseshoe well in Haynesville had an initial production rate of 31 million cubic feet a day. So it's quite incredible there. And they have now completed and TIL'd their 13th well in the Western Haynesville Bossier. They expect to have 5 additional wells to be turned in line in late 2024 and early 2025. And the Bossier in Western Haynesville in Texas is going to be a big enough subregion to, or big enough area to where we're going to have make that a new separate subregion. Expand Energy said that their operational efficiencies continue to improve, and they're looking to spend less and produce more, which is going to be typical of the norm for many natural gas producers. Going further out, longer term, 2026 and 2027, what was interesting, since if you look on the graph on the Henry Hub NG forward curve graph there, what was interesting is, wow, 2025 prices fell from last quarter. We saw 2026 and 2027 natural gas prices at the Henry Hub go up a little bit. So overall, the forward curve is incentivizing higher production, especially when you factor in compounded efficiency gains in drilling and completions. And so we've got that going on there, even though our forecast is revised down slightly for 2026, 2027. That is only because we revised down 2025, and because 2026 and 2027 are very path dependent on 2025. But still, our year-on-year changes for 2026 and 2027 have not changed from what we did the prior quarter when we did our forecast on November 11th. So overall, things are the same in 2026, 2027 from what we were expecting last quarter. And in the lower 48, there is enough pipeline capacity and LNG liquefaction additions to allow for significantly higher production, especially in Texas and Louisiana, and especially since we've now got FID on the Warrior Pipeline in Texas. Overall, the compounded growth rate in lower 48 production for 2026 and 2027 is going to be 3% growth for those 2 years, which at these levels, at around 103, 103.5 BCF a day, current levels, that's going to add up to quite a bit of growth, a good deal higher numbers. We should be around 113 or 114 BCF a day in lower 48 production by the time we get into December of 2027, and especially with the LNG boom materializing. Looking at the Northeast Permian and Haynesville for natural gas for 2026 to 2027, we did not change anything in the Permian on November 11th compared to the prior quarter, and we lowered the Northeast and Haynesville slightly on November 11th compared to the prior quarter, but that was only because we lowered the base 2025 level a little bit on November 11th. And so 2026 and 2027 are path dependent on that. But still, the year-on-year changes are the same compared to the prior quarter. The Permian is expected to grow 6% in 2026 and then another 6% in 2027. Haynesville is expected to grow 5.5% for those 2 years each year, and the Northeast at a much more modest rate of 2% growth for 2026 and 2027.
So oil is blessed, and I use that term very lightly, with a more complex set of fundamentals in many ways than the gas markets. So you always have to start whenever you talk about what's changed over the quarter by discussing OPEC. In this case, it appears that OPEC has decided, and pretty clearly, that they're going to defend price and not market share, at least for the near term, with the production increases being put off at least for 3 months now, and probably pretty continuously, I would guess, through the year. Mostly in the face of a poor prognosis for demand in general across the world, and Chinese demand, which has been the growth engine in particular. The big news out of China, I think, is the battery vehicles have matched petroleum vehicle sales. Now, they define battery vehicles, new energy vehicles, their exact term, as only plug-in hybrids and EVs. And not only according to the graph below with official government statistics, but their Automobile Association, which tracks more recent, their Manufacturers Association, which tracks more recent numbers, have exceeded 50% sort of every month up through and including October. In addition, heavy transportation, if you look to distillates for a bright spot, you're going to be disappointed because the movement of CNG into an LNG into heavy transportation is also accelerating into China. IEA is now forecasting that Chinese demand will peak in 2025. They've moved that forward 5 years just from their last quarterly forecast to this one. Now, the curve itself has tilted more into backwardation as the market appears to become a little more pessimistic on future demand expectations. And it's actually, as of yesterday, was up a little bit more than this. I haven't seen it this morning, but it does not really appear to have changed behavior much at all in the United States. I don't think it's changed anybody's opinion on what they're going to do for the most part. And that's really, so our forecast then has changed really on the 3 things we've mentioned already. Freeze-off severity, New Mexico realizations, which have lifted the front end, and then something new, a little bit higher Gulf of Mexico on the back end. Now, we've talked about the strong efficiency gains in the Permian. So we expect 2026 and 2027 production to increase about 1.8% combined annual growth rate for those years, which is less than the 3% annual growth rate for lower 48. But as you can see from the graph below, the new forecast, and I apologize for the new and old being reversed on colors here on those 2 graphs. The new is orange. As you can see, it comes up just a little bit, but those reduced freeze-offs really make the difference in lifting the whole curve. This is broken down by region, and I don't need you to read the numbers to you, but as you can see, the North Dakota I find interesting, simply by reducing our freeze-off assumptions, it looks like it's overall lower, but actually increases just a little bit overall compared to last quarter. And Gulf of Mexico actually, as you see in these out years, the reduction, the removal of that freeze-off assumption, which probably shouldn't have been in there in the first place, it increases our back end, and really into 28, 29 is when you really see some pretty substantial rises in Gulf of Mexico, at least compared to where, everyone was expecting it to go 10 years ago. And that's really the result of these 20,000 PSI wells and technology that I think both Chevron and BP have pioneered out in the super deep water. That technology has really unlocked incredibly productive wells, with them quoting numbers like $35 to $40 per barrel break even. Now, enormous projects, you're not drilling, 5 of them at $10 million. It's a couple of $1 billion project, but still, the US is really moving off of being the marginal provider potentially, which would be an interesting development. Even though we're the largest, we've always been sort of the marginal provider. But if prices start to go down, it will be interesting to see who comes off first, because it looks like it might not be us. And with that, I think we would normally go to questions, but as we've alluded to, we welcome your questions and by any means you want to reach out to us.
Yeah. I want to thank everybody for taking the time to watch a recording. Again, sincerest apologies we weren't able to get the webinar working live. We do want to make sure that you were able to answer your questions. Send us emails, support@cinmax.com. Even if you'd like to set up a call with us and discuss this verbally, support@cinmax.com. We'd be happy to get you on our calendar, answer any questions you might have about the presentation.
Okay, everyone. Thank you so much. Take care.